Domestic equity market has witnessed strong recovery over the last 2 years. Corporate earnings growth has been the primary contributor to this performance. India is expected to be one of the fastest growing economies over the next year. Given the broad-based earnings performance last year, going forward it is likely to be more bottom-up across sectors. Hence, we expect CY22 to be a year of consolidation. Across equity mutual fund categories, actively managed funds on average have outperformed the respective benchmarks over the last 1 year. RBI is more focused on growth than inflation at this stage. It is very likely that the monetary policy normalization in India would be very gradual. Headline CPI inflation is expected to average at 5.4% in FY22 and likely to ease towards 5% in FY23. USD exchange rate to INR is expected to average at 74.7 in FY22 and likely to depreciate to 76.4 in FY23. For the broader universe of companies, earnings growth has been the primary contributor to price performance over the last year. Our proprietary temperature gauge index indicates that markets are in the fair valuation zone. Hence, for incremental allocation to equities, we suggest 50% deployment immediately and 50% to be staggered over a period of 3 months. We continue to maintain bias towards multi-cap and select mid and small cap strategies across MF, PMS, AIF platforms. In the last 1 year, USD/SEC yield curve has shifted upwards primarily due to inflation concerns. The domestic yield curves are steep and expected to flatten over the next 2 to 3 years. For the fixed income investor, we suggest following a barbell portfolio approach that is having core allocation to high quality accrual oriented funds with short maturities, complemented by 20% to 30% allocation towards long maturity and high quality roll down strategies. Tactical allocation to select high-yield strategies, MLDs, REITs, inverts can help enhance the yield on fixed income portfolios. A comparison between gold and silver shows that silver exhibits far more volatility and drawdown. Hence, while gold can have a strategic allocation in portfolios, silver should be considered only for tactical allocation. Gold should be treated predominantly as a hedge against heightened volatility. Investors can participate through gold funds and sovereign gold bonds.